This is Mike Fernandez, your local realtor and real estate investor here in St. Bernard Parish. I've been trying to put out some more videos recently, trying to get people started in real estate investing. What's that look like? And help people either take their first step or their next step to get involved into investing in real estate and rental properties. I'm really excited about today's video because I'm going to sit down and I'm going to interview Jake Peralta. He's a local loan officer with Performance Mortgage here in St. Bernard Parish. Awesome guy, does fantastic work. I use him for all of my stuff personally, recommend him to all my clients. And he's going to walk us through from the lending perspective what that looks like, how to get started, what do you need to do, what are the requirements. He's going to break it down step by step. I'm super excited. Like I said, he's a fantastic guy. He's going to share his contact info. But I'm really excited. This is a perfect video for somebody who's thinking about getting into real estate investing, or maybe you're just getting started, about to put an offer in, thinking about putting an offer in. Jake's going to walk us through every step of the process, and I think it's going to be a fantastic video. So without further ado, here we go. What's up, everybody? So here we have Jake Peralta. What's going on, Jake?
What's up, man? Not too much. How are you?
Good. Hey, thanks for jumping on, man. I'm excited to dig into the financing side of investing. So tell, for those tuning in, tell us a little bit about yourself, man. Give us a little bit of background.
Yeah, man. So I got my bachelor's degree in accounting. I'm currently working as a loan officer at Performance Mortgage right here in Chalmette, where we specialize in conforming loans, and I'm also a real estate investor.
Nice, fantastic.
The extent's kind of limited to rental property investing. I haven't done any flips or anything, but
nice, excellent, man. Cool. Yeah, thanks for jumping on. I'm excited. And so as a background for those of you tuning in, the intent for this video, I think what we're hoping for today is to just have a, if you're brand new, just starting out, want to get into real estate investing, but you're like, I don't even know where to start. Where do I look? Where do I start? How do I even get approved? What do the loans look like? What kind of loans can I use? We're going to talk about all that today, or I should say, Jake's going to talk about all that today. So hopefully this is just a ground level. Here's where to start. Here's how to get started.
Yes, sir.
So with that, Jake, what do they do, man? Somebody says, I want to get invested in real estate. What's the first step on your end from the financing perspective?
Well, the first step is definitely to get pre-approved. So talk to me first. Real estate agents generally want that pre-approval letter before they go out and show you a bunch of properties, just because in this market, it's so hot, you definitely want serious buyers. So talk to your lender, get pre-approved. And even if you can't get pre-approved, by talking to a lender, they can kind of tell you what you need to do, what you need to clean up in order to get pre-approved. So that would definitely be the first step.
Nice, perfect. And what kind of loans are there out there? Like what options do I have if I'm looking to buy a duplex or fourplex or something? What options do I have?
Right. So there's two options. You can buy it as an owner occupied deal, or you can buy it as an investment property straight up. There are one advantage, in my opinion, to doing both. Buying as owner occupancy, obviously you can put less down. You get maximum financing. So you can get in as little as 0 to 5% down. Buying as investment property, the primary benefit is you cash flow better for two reasons. One, you're leveraging less debt, and two, you have no mortgage insurance because you're putting down 20 to 25%. So those are going to be the primary advantages to both of those options. It's still advisable for your first deal to do an owner occupancy situation, because you're really only going to be able to do that for your first or maybe your first couple of deals. So I would recommend doing it. And that's what I did. I put down 5% on my first house. I moved out, put 5% on a new primary residence, rented the old property out. And even if you have the 20% down to put down, I would still say do the owner occupancy deal first, because you can save your chatter for the next property. It's kind of like a jump start. So nice. When you're looking, the caveat to using some of these government programs like FHA, VA, USDA, is you have to intend to occupy the property as your primary residence for a minimum of 6 months to a year. So that has to be the intention when you're using, because that's what the programs are for, owner occupancy. I'll preface this by saying that there are many creative ways to get financing. I'm here to talk about conforming loans. Nice. Conforming loans conform to Fannie Mae and Freddie Mac's guidelines, which are quasi-government entities. So basically what that means is that the government is making the rules and regulations surrounding these loan programs and not the mortgage lender themselves. So think of us as like the lawyers interpreting the law and not the lawmakers. And don't kill us when we need 1,000 things because of that. So why would you want to go with a conforming loan? Well, because conforming loans in most cases are going to offer the most attractive rates and terms out of any other financing situation that you're going to come across. So we should start with the best loan program known to man, the VA loan.
Nice.
Which
before you jump into VA loan,
yeah.
Can I stop you? You mentioned something PMI. For somebody who may not know what that is, can you explain what PMI is?
PMI is just private mortgage insurance, and it's to protect the end investor, because whenever you put in minimal skin in the game, you're deemed a more risky loan. So that mortgage insurance is to cover the investor's ass.
Right.
So that's what PMI is. There, for the government loans, PMI is permanent. It's on there for the life of the loan. It does go down because it is a percentage of the loan balance. So it does go down as you pay the loan down. I wouldn't really worry about it too much, just because you can always refinance out of it once you reach a 20% equity position into a conventional loan and get out of it.
Nice.
And like I said, you're only going to be able to do those deals, you know, your first property, maybe your first couple of properties, depending on how okay you are with jumping around. But I would take advantage of it while you can.
Yeah, absolutely. Nice. Thanks for clearing that up. So sorry, I didn't mean to interrupt you. You were talking about VA loans.
No, it's all good. So that kind of brings me into like the primary benefit of the VA loan. With the VA loan, obviously exclusive to vets, but if you qualify, you can get 100% financing, so no down payment, and also no mortgage insurance. So that right there is huge, because those two things in any other context do not go together. You're never going to get that. So it's a very attractive loan. There is a funding fee associated with it of 2.3% if you're a first-time user, and 3.6% if you're a recurring user.
And that just gets tacked into the loan, right?
Yeah, it's just rolled into the loan amount. It's meant to keep the program liquid so they can continue to lend out at 100% financing for our vets.
Nice. And I can tell you, it's a fantastic loan. We bought a fourplex with the VA loan, and it's a great feeling walking away from the closing table getting a check instead of having to bring one, because between the prorated rents, the taxes, and then getting the deposits back from the old landlord, we actually walked away with a check, which is
it's incredible.
Nothing like it.
It's incredible, man. So you're actually exempt from this fee if you're a disabled vet. So if you're a disabled vet, you don't even have the funding fee.
That's awesome.
You can use this program for anything from a single family dwelling to a fourplex. You've done that yourself. So that it's bananas that, and not bananas because our vets deserve it, but it's an awesome benefit to be able to get into a fourplex or a duplex with nothing down. That's crazy.
Yeah.
The qualifying factors for this loan program,
nice.
On paper, the debt to income ratio, which all debt to income is your monthly obligations, or the monthly payments, I should say, on those obligations divided by your monthly debt. But divided by your monthly income.
Right. And those obligations, what is that? Does that include like my cell phone bill, anything like that? Or what generally is included in that?
It's going to be anything that shows up on your credit report. So basically it's going to be your installment loans, your proposed housing payment is going to be on there, your education loans, credit card bills, things like that.
Nice.
So on paper with the VA loan, it's 41%, but in reality, you can go much higher than that. With compensating factors such as money in the bank, good credit, we've seen it go as high as 70% for VA loans, which is crazy. The credit, there's actually no official credit score requirement, but for most lenders, it's going to be 620.
Got it. Okay.
So very loose on the requirements to get pre-approved for this loan, which is good because they want as many vets to get pre-approved as possible, pretty much.
And if you're looking at a double, a fourplex, something like that, isn't it true I can use the rental income that it's currently collecting to help me qualify, or no?
That is true. It depends on the loan program. If I'm not mistaken, I think with the VA program, you actually, I think you may need to have like 6 months of experience in rent.
Yeah, I think that
Did they require that from you?
Yeah, they asked about like landlord experience or something. I think that was the VA. I've had that come up before. I think it was with the VA loan. I think you're right.
It's different for every loan program, and I want to say the VA loan's actually the only one that you need. Like, I think it's only like 6 months of experience.
Right. Yeah, I think you're
So
right.
it's not a crazy amount, but for the other programs you don't need it.
Nice. Okay.
So let's say you want 100% financing, but you're not a vet. You're going to be looking at the rural development loan program. You can only use this program for single family dwellings. So that, that kind of sucks, but there are situations where you can find a single family dwelling with a fully functional mother-in-law suite. And if you're as crazy as I am, you'll live in the mother-in-law suite and you'll rent out the single family dwelling. I didn't tell you that though. The debt to income requirements for the USDA program are the strictest. It's 41% on the total debt to income, and you're really not going much higher than that. With compensating factors, you might be able to squeeze 45%, but generally speaking, you're going to be looking at 41%, a hard line. So it's very strict. For the credit score, it's a little bit looser. You can go as low as 620. So the credit score doesn't have to be as cleaned up, but the debt to income is pretty hard line. There is mortgage insurance tied to this loan program for the life of the loan. It is a percentage of the loan balance, so it does go down in dollar amount as you pay the loan down.
Nice.
There's also a guarantee fee similar to the funding fee of 1% that's rolled into the loan amount and meant to keep the program liquid. Let's see.
Nice.
I think that covers all my bases for rural development.
Okay.
If you want to do a multi-family deal and you want maximum financing, you're going to be looking at an FHA loan where you have to put 3.5% down, but you can put 3.5% down and get a duplex, get a fourplex. So that's pretty huge. Just like the USDA loan, there is a mortgage insurance tied to the loan for the life of the loan. It does go down with the loan balance, and you can always refinance out of it once you reach that 20% equity position. And you don't, if you're occupying it as your primary residence, you don't necessarily have to wait to hit that 20% equity position. But if you move out and it then becomes an investment property, now you have to have 20% skin in the game. So I wouldn't worry about it too much. You can always refinance out of it. There's also a uniform residential mortgage insurance premium similar to the funding fee and the guarantee fee. It's 1.75% rolled into the loan amount. Debt to income wise, this one, outside of the VA loan anyway, this one is going to be the loosest. On paper, it's 41%, but in reality, you can go way higher. You can go up to 56% on this one.
Wow.
Credit score wise, it's the most flexible because you can go as low as 580 on the FHA loan. So FHA loan, kind of great situation if you're looking to get into a duplex or a fourplex with minimal skin in the game. If you're not a vet, if you're a vet, go VA all the way. And I know with you did a VA loan and then you moved out and then you utilized the FHA loan.
Vice versa, but yeah, we've done one of each. Yeah.
Okay. Yeah. So obviously you can see how utilizing the maximum financing government loan programs can be highly beneficial to get you that kickstart.
Right.
The last loan is going to be your bread and butter loan for investment property financing. So this is the loan program you're going to be looking at when you're buying purely as investment property.
Right.
It's the conventional loan. You can use it for owner occupancy, in which case you can put less down. Mm-hmm. But with this loan program, when you're buying for the intent of investment, you're going to be putting down 20 to 25%. 20% down for single family homes and 25% down for multifamily units. So this is where you need a lot more skin in the game, and you can see how investing in real estate, you're not going from 0 to hero. You have to save up a decent chunk of change in order to get into the game. And that's why I'm a big advocate of utilizing these maximum financing loan programs while you can. Because once you get to this road, this is where it gets tough. Yeah. So with conventional loan program, you're really not even looking at this loan program unless you're a minimal of 680 credit score and preferably 740, because that's where you're going to get the best interest rates for this loan program. Debt to income wise, on paper, 45%, 50%, you can get some allowances if you have an overall good profile.
Right.
With owner occupancy, you can go as low as 3% down. So
Nice.
you can get a maximum financing deal with this program as well. But for investment property, 20 to 25% down. So
right,
it gets pretty hefty.
Yeah, which is a
No
big
more,
difference,
no,
right? You
yeah,
figure, let's say a $200,000 duplex, let's say, right?
yep,
$200,000 duplex FHA loan. That's what I was just looking, doing the math. That's your 3.5%. You're looking at what, $7,000, right? Whereas
right,
20% down is, check my math here, but 40 grand, right?
right,
So
right.
huge difference, and I guess it just depends on where somebody is in their career life, right? Investing, how much cash they have on hand would dictate what options they have.
Exactly. Yep.
Yeah.
And if you're owner occupying a duplex or a fourplex with conventional, you have to put down 15%. So it's a little bit less, but it's still a decent chunk of change.
Yeah.
So really, your best option for maximum financing with duplexes and fourplexes is either VA or FHA.
Right.
100%.
Yeah,
So
like you said, just the only downside really is that the PMI, which you can always
yeah,
refinance out of and pull out if
right.
it's that big of a deal. Which in my experience, I think the one we had, it was a relatively cheap loan. I want to say it was like 100, 200, something like that. Does that sound about right in the ballpark for
Yeah,
that
yeah,
PMI?
yeah, for sure. And the thing is, like with the FHA and the USDA loan programs and the VA loan programs, you're offered what's called a Streamline Refinance, where you don't need an appraisal. And
Nice.
our company doesn't charge you any mortgage broker fees, so you save money that way.
Awesome.
So, I mean, if the PMI, if it's really hefty and you need to get out of it, then I would say refinance into a conventional deal. But it doesn't really hurt that bad, as you can see, especially with the competitive rates that you're going to get with those
Right.
programs.
Yeah. And it's a foot in the door. You know, if you're
Yeah,
somebody where you're like, I just don't have 40, 50 grand laying around to put down
right.
a 20% down payment plus closing costs, plus having reserves, plus, all this other stuff.
Yeah,
It's a way to get your foot in the door, get started, get some extra revenue generated to start saving up to get to that point where you can start putting money.
exactly. And that's part of the reason why I think real estate is so attractive, is because you can leverage debt, and you touched on this in your videos, but you can leverage debt to finance most of the property's value. So it kind of gives you, and there's multiple ways to skin a cat. You can invest in a 401k for a career and retire a millionaire and be good. But I just think you get more bang for your buck in real estate because you can leverage that debt, and you can move a lot faster by
Yeah.
utilizing that.
You said the optimal word right there, man. Leverage. Leverage is everything.
Yeah.
You said the beauty of real estate, man. You get 100% of the benefit, but you're only putting 3.5% down. It's
exactly.
incredible.
So we talked about the down payment. There's another side to the coin, and that's the closing cost. And I'll explain in a minute why closing cost is so individualized to the specific property, and there's really not a clean cookie cutter answer as to what closing cost is going to be, because what closing costs consist of is your appraisal fee, your mortgage broker fees, your title work, and your escrow padding and prepaid items. So your escrow padding is going to be 3 months reserves of homeowners insurance and 3 months reserves of flood insurance if you're in a high risk flood zone, and about 3 months to 11 months of taxes is what you're going to need in your reserve escrow account. Your prepaid items are your first year's homeowners insurance is due at the table, so you're going to have 1 year premium due, and then 1 year premium for flood insurance if you're in a high risk flood zone. So depending on what the tax and insurance comes back at, that's really going to make up about half of your closing costs right there.
Yep.
With the government programs, VA, FHA, and USDA, you're allowed to ask the seller to contribute up to 6% of the purchase price of the home in seller paid closing costs. So the seller can actually pay a portion, if not all, of your closing costs. In my opinion, 6% is normally overkill. You normally never need that. It usually is about 3 to 4.5%, I would say, depending. I mean, there are situations where it can exceed or be lower than that, but
unless you're
that's
buying
kind of
a
like
$50,000 house, right?
yeah, that's going to be your ballpark right there. With conventional, and you're not entitled to this. This is up for negotiation. This is what you're allowed to ask. So depending on the overall competitiveness of the market, you may or may not be able to get this. one strategy that I like to look at is if you need the closing costs, say you need $5,000 in closing costs, you're thinking about offering 160,000. Consider offering 165,000 and ask the seller to contribute that $5,000 in closing costs. So you don't have to come up with out of pocket at the table, and the seller is netting the same regardless. So that's one tactic to use. With the conventional program, it's cut in half. You can only ask 3% of the purchase price of the home and seller concessions. If you put down 20% down, you can ask 6%, but most people aren't going to do that, especially for owner occupancy. Most people are going to put down like 5-10%. And it's advisable, in my opinion, to do so. With when you're buying with the intent of investment property, you can only ask 2%. So obviously, you know, you got the 25% down payment on a multifamily unit and you can only ask 2%. So this is where real estate, a lot of people want to go from zero to hero, but you really have to save your money to get in the game later on. Obviously, you can utilize these owner occupancy financing deals early on, but eventually you're going to come into that. You're not going to want to move around forever.
Right. Yeah.
So.
Freeze up for a second. You still there?
Highlights the. Yeah, I'm here.
Okay, cool.
Can you see me? Can you hear me?
Yeah, good to go.
Yeah. So that kind of highlights the overall key details. There's obviously much more, but that's a quick rundown of the key details of the loan programs.
Nice. Excellent, man. So yeah, so theoretically, you know, if I'm looking at, like I said, we'll use that $200,000 duplex example. Instead of looking to put, you know, $40,000 in down payment plus another, you know, $7,000 in closing costs, theoretically, I could have the seller pay all those closing costs, and then I could get in from a 3.5% down. So I could write a check at closing for $7,000 and move into my half of that duplex there, rent the other side out. 1 year later, move out, renting both sides out, and you could either rinse and repeat with another, or now, is there a rule? Let's say I wasn't a veteran, I wanted to do FHA. Could I just rinse and repeat FHA loans over and over again, or are they going to cap me out?
No, you're limited to one outstanding FHA loan. There are situations where if you move a certain amount of distance away and you're like upgrading, you might be able to do it. But for our purposes, you can only have one FHA loan at a time.
Gotcha.
It's very unique situations where you can have another one outstanding, and it's very rare. I've never done a deal where you're doing an FHA loan on a borrower who already has an FHA loan.
Right. Cool. So that's good to know too, right? You can only have one. So after that first one, you either need to refinance, get a new FHA loan, or to start to get a little bit more creatively or utilize some more cash, right?
Right.
Yeah.
But yeah, you're really going to be looking as conventional is kind of like the bread and butter loan for real estate investors. Yeah. Obviously, early on, you can utilize some of the government programs, but it's going to be, for the most part, especially if you're buying with the intent of investment. You can't even use it. If you're buying for the intent of investment, you can't use a VA loan. VA loan is exclusive for owner occupancy, so you have to intend to occupy. So you got to think about that if you're looking to buy. If you're looking to be a slumlord, you got to think, would I live here? Because you're gonna have to.
Yeah, and like you said though, right? You can do it as long as you live in it for that first year, 6 months, a year, whatever the situation dictates, right? Nice, good to know. Nice. And then what about like down? Is there a way, let's say I was super strapped for cash, is there a way, if the seller didn't want to play and didn't want to help out with closing costs or anything like that, is there a way I can get a gift for the down payment? Or is there a way somebody, my parents or somebody, can help me out with that down payment?
Absolutely. As long as it's a direct relative. So we'll have to source everything. We'll have to source it coming out of their bank statements into yours. We'll have to get a gift letter. You can't do that for investment property. You can only do that for owner occupancy.
Right.
But yes, gifts are acceptable.
Nice.
For direct relatives anyway. You can't get a gift from a friend.
Right. Or from the seller, huh? Yeah.
No.
Yeah.
There are also situations where you can get lender credits. But one thing I stress to people is that nothing in life is free. When you do a lender credit, what happens is when we look at our spread, we have par interest rates. We have interest rates that are a little bit higher that pay that actually investors will pay more to acquire the loans.
Mm-hmm.
And then you have your discount points where you as a buyer can buy down the rate. So whenever you are getting a lender credit, basically what happens is the lender is jacking up the interest rate and giving you the credit because they're getting paid for the higher interest rate. So that's what happens.
Right.
Nothing's free. And they might not tell you that, but that's what's happening.
Right. That's what my dad used to always tell me when I was a kid. No such thing as a free lunch.
Yeah, my dad used to tell me, if it sounds too good to be true, it probably is. And that's served me very well throughout the years because it's proved to be true.
Nice, man. Oh yeah, 2 more quick questions for you. So let's say somebody is not quite ready yet, but they're looking, they're going to be graduating soon, get married, whatever. Things aren't timing's not right. Timing's not good right now. But let's say they're looking out 2 to 3 years from now, they're going to want to start investing in real estate. What are some things they can do now to help their future self out?
Right. So there's really no secret. The best thing you can do is just start saving your money. If one tactic that I used, I knew I wanted to get into real estate when I was in college. So every time I would spend money on something stupid, I would feel like I'm taking away from my overall goal of getting in real estate. And that's one psychological trick you can play on yourself in order to get you to save the money, because saving the money is the biggest piece of advice I could tell you. Because with real estate, I know I said this before, but you're not going from zero to hero with real estate. You're just not. I mean, you can utilize owner occupancy financing for a little bit, but you need to save your money. And then the second thing would be just to study as much as you can. Read books, watch YouTube's a great way to educate yourself. So there's enough cheap and free education out there that you really don't have to spend a ton of money. I'm very wary of gurus. I would never pay someone a tremendous amount of money in order to teach me something that I could learn in a book or on YouTube, for that matter.
Come on, man, you're killing I'm just about to do a commercial for my online class.
and like, I mean, you meet people when you dive into a space. I met you. I've learned a lot from you. I met my boss, Andy. I've learned a lot from him. So there's enough people out there. You get relationships, and they'll be happy to help you out. Anyone who's your true friend will give you the information that you need. I wouldn't jump into a relationship being like, will you be my mentor or something? Because that's just weird. But you meet people, you learn things, you dive into the space, and you don't pay someone 10 grand to teach you something. That's just silly.
That's a great point, man, because you're like, just human nature. People love to talk about themselves and what they've done, right? So if you ask somebody, even if somebody you don't know or barely know, hey man, tell me, how did you get started? I'm sure 99% of people are going to love to tell you the story, how they started, where they messed up, and all that. You know what I mean?
Oh, and here's another thing. You'll learn this when you start to get into real estate investing. Be very wary of unsolicited advice, if that's how you say that word. I have trouble saying that word. I've had advice that I haven't asked for coming out of all and if you know someone and obviously you have a relationship with them, that's way different. Right. But when people are coming out of the woodwork, it's a little weird, and I'm kind of weary of it. Like, I don't really give it too much weight.
Yeah. And you said something earlier too that I really like, that I like to circle back on. You mentioned, you're not going to go zero to hero overnight, right? You kind of talked about personal finance and saving money. And honestly, that's the foundation of it all. Like if you can't manage the income from your job and your current bills, real estate's not going to be your savior, right? Like real estate is going to be the gasoline on whatever fire you have, right? So if you're terrible with your finances, and every dollar that comes in, you're spending it on some foolishness, right? Real estate is not going to help you out. If anything, it's probably going to make your situation worse. So, you know what I mean? I think part of that is just making sure you're focusing on the fundamentals, having a budget, saving money, putting money aside, having an emergency fund, all those like classic, I should say, personal finance 101 things is going to lead to you being able to get to it. But if you can't master it here, it's not your life vest. You know what I mean? It's not going to pull you out from sinking under your
1,000%. That's the perfect way to put it. If you're leveraging a lot of debt when you get into real estate, and that can be a good thing or it can be a freaking terrible thing. So if you can't manage your credit card debt, if you can't manage, your student debt, then how are you going to manage, a $250,000 mortgage? So
and if you're not setting money aside for repairs and vacancy and CapEx and all that money that's coming in, you're just spending it, then when it comes time to pay the piper, it's going to be a painful experience.
Oh yeah, 100%. And leverage is a fantastic thing. I mean, most people who end up being extremely wealthy, and there's obviously exceptions, but most people who get extremely wealthy are leveraging debt, and they're acquiring assets, and they're keeping those assets, and they're borrowing against them to live their everyday life. They're not holding on to cash. I know that's a foreign concept to most people, but they're investing their cash. They're not holding on to it. It's dangerous to hold on to cash, especially in an inflationary economy. It's very dangerous. So, and debt works both ways. As your as the value of the dollar goes down with inflation, so does the value of your debt. So it ends up being a great hedge against inflation.
Yeah.
And that's the one secret that the wealthy know. They don't hold on to cash. They invest it.
Yeah. I think it's Mr. Wonderful, right? You know what I mean? Like you're either dollar, if you spend it, he goes out and dies. But if you invest it, he's going out recruiting more dollars and bringing them back to you. Yeah.
Oh yeah, 1,000%, man.
Yeah.
That's the things that the wealthy people are teaching their kids at the dinner table, and something that the majority of the middle class and poor have not figured out yet. They still think they can save their way to wealth, but it just ain't happening unless your income is $500,000 a year, 250,000 a year, then maybe. Right. But if you're a regular everyday guy, you really need to invest in assets to protect your wealth and to gain wealth.
Right. Love it, man. Love it. I think that's all the questions. So hey, if somebody wanted to get in touch with you or wanted to, reach out to you, get started, where can they find more info about you? How can they get in touch with you? Give us all of that, man.
Yeah, so I'll put my number out there because I advertise all the time on Facebook. But my number's 504-579-4592. So if you're interested in getting pre-approved, or if you just want to talk about what you have to do to get pre-approved, definitely give me a call. I have no problem with grooming people into a pre-approval, even if it takes several months. Have no problem with it at all. You can also email me at jperalta@performancemtg.com, and you can find me on Facebook, Jacob Peralta.
Nice. Love it, man. And I'll tell everybody the thing that I absolutely love about Jake, and I've worked with, over the course of investing, a lot of loan officers, both as a realtor and personally as an investor. And the thing that I love about Jake, or the thing that I think Jake has that a lot of them are missing, is the ability to figure stuff out and problem solve. And that's what I tell all my clients. Look, something comes up, Jake's going to figure it out. You know what I mean? Like it may not be possible, but if it is possible, he's going to figure it out. Whereas I've had loan officers in the past that they're like, oh, hey, this popped up. Sorry, I killed it. And, better luck next time. And I'm like, wait, what do you mean? Why can't we just do X, Y, and Z? They're not willing to take those next couple steps, but Jake's the man. He's willing to go above and beyond. And like I said, just actively problem solve to make the deal happen.
I appreciate that, Mike. I could say the same for you, man. And, one of the best pieces of advice I got, and I can't take credit for this, I got it at a jiu-jitsu seminar, go figure, nice, from Ryan Hall, was that the main thing you can have is the belief in yourself to figure things out for yourself. Because you'll talk to people, and not everyone, you can find good friends that are going to give you the keys to what they've figured out. But ultimately, people aren't just going to give you information for free unless they're a good friend. And chances are they're withholding something. So you got to believe in yourself to figure things out. And that's where reading books, educating yourself on YouTube, whatever it is, comes into play. You got to believe in your own ability to figure things out. And that's, for any job, real estate investing, whatever it is. Yeah. So that's, to add on to what you asked me about what someone can do to get started, believe in yourself, believe in your ability to figure things out, and you'll be fine.
Love it. Fantastic, man. Any closing notes? Anything else?
I don't think so. I'm sure when we get off the video call, I'll have probably 100 things that I wanted to say, but as of right
look
now,
for part 2. It's coming. The sequel's coming back soon.
Part 2, baby. Yes, sir.
Cool. Well, thank you, Jake. It's been fantastic. Awesome information. And hopefully people reach out with any specific questions or anything that I'm not smart enough to answer. But appreciate your time. And
brother.
I'm sure I'll see you on our evening walk later. I think we'll be walking that way.
Yeah. And one last thing, I'm sure we could start doing this a lot more and we'll get a lot better at it. If the people like it, like you said, if even one person watches this and gets something out of it, that's awesome.
Yeah, absolutely.
I have fun doing it. I know you have fun doing it. So
sir.
Let's get it.
Yes, sir. Appreciate it, Jake.
All right, brother. No problem.